Happy Monday, everybody. I hope you had a great weekend. Seems like markets took the idea of taking a break seriously. After a strong run this year with a lot of catalysts to speak about, markets spent last week mostly in the red and actually put up a slightly negative week. Why do I say it like this? As you recall, there really was nowhere to go in the past few weeks to get the other side of the story. Rainbows and unicorns. Everyone was discussing how this market had nothing in the way and it would be holding to historic norms and going into the election up as strong as it was, it'll keep going. Let's get into last week's market and then we'll preview this week. Today is November 18th, 2024, and this is your Monday market update. In case you were wondering, hurricane season ended right before the election, so any storm that's brewing will not get that kind of reference, though Jamie Dimon from JP Morgan did call for an economic hurricane a while back, actually June of 2022. And as we've come to see, even Jamie Dimon, as good as he is, cannot forecast the weather. Before we go too far into the recap, I just want to note that there are so many predictions flying around. The one thing that no one is paying attention to is an overall issue in society today, but that's a different conversation, is accountability. The incumbent party winning if the market is up and so much more. There was an article in the Wall Street Journal this weekend that spoke about the betting sites, like we spoke about prior to the election, and if they are the new polling place. My point is our goals need to be more clear. We need to separate the signal from the noise. And as I've been talking about in the Friday videos and with so many of you in meetings, it's time to do an audit of your risk profile. Not calling a market top or even a market bottom. What I'm saying is that as we have now hit record highs on the S&P 500 more than 50 times this year, now's the time to evaluate your risk. Okay, let's go through last week. Veterans Day 2024 and post-election optimism continued to drive markets higher on Monday, with investors anticipating pro-business policies from the incoming administration. Markets gapped higher at the open, but with no other news to drive things, it turned sideways. The S&P 500 rose 0.1% and did close above 6,000 for the first time. It was a mixed tape, but overall was quiet. Consumer discretionary up 2%, financials up 1.5%, the industrials up 0.75%. Those led the gainers, while real estate was down almost 1%, lagged with rising rate expectations. At the end of the day, pretty quiet. The Dow was up about 0.75%. S&P, as I mentioned, up 0.1%, and the Nasdaq up slightly. Biggest newsworthy move can go to the dollar, up over 0.5%, closing in on 106. If it gets too strong, it will be a headwind on this U.S. economy and to earnings. Tuesday, markets opened little change. It seemed that the post-election rally paused. Treasury yields rose above 4.4%, driven by hawkish Federal Reserve commentary, including remarks from Fed head Kashkari on possible rate cut pauses if the inflation remains elevated. Although it's not watched too closely, I think it should get more attention. The Small Business Optimism Index exceeded expectations, coming in at 93.7 versus the anticipated 91.7. It indicated increased confidence among small business owners. That is a big deal. They can be wrong also, but they are the backbone of the economy. By the end of the day, the Dow was down about 1%, S&P down about 1/3%, and the Nasdaq was down less than 1/4%. Wednesday's stocks looked like they may move higher again, gapped higher at the open, but that was not to be. October's CPI met expectations with headline inflation at 2.6% year over year, core inflation at 3.3% year over year. By the way, no matter what people say, unless the Fed moves the goalpost, that is still not the 2% that they're hunting for. The Treasury reported a larger than expected deficit of $257 billion, raising concerns about fiscal sustainability. Recall that we speak here a lot about the amount of U.S. Treasuries we'll have to bring to market. The higher the deficit, the higher that number, chances that the yield to come down are slim. More Fed heads speak Logan this time, and yields are sticking over the 4.4% level. At the end of the day, Dow was up 0.1%, S&P up just 0.2%, essentially flat. The Nasdaq was up less than 1/4%. Markets opened little changed again on following the PPI release on Thursday. October's PPI showed modest increases, pretty much in line with expectations, bringing some inflation concerns. Federal Reserve Chair Jerome Powell's comments suggested flexibility in the Fed's rate cut timeline. That's new, casting doubt on the likelihood of aggressive cuts in 2025. Mixed labor market signals did emerge with initial jobless claims at a multi-month low, but continuing claims are rising. Dow was down 0.5%, S&P down about 2/3%, the Nasdaq was down about 0.75%. Friday saw what I thought was the most important number of the week, the retail sales number, and once again, the numbers held up. Details were a bit more negative than headlines, but the revision to last month brought it pretty much in flat between the 2 months, but not falling off a cliff. Remember, in my opinion, this market is priced for perfection, and the part that is that we don't know that the economy, that we do know, is the economy is losing momentum. But if we stop moving forward, moving backward becomes easier to see happen. So we'll watch this and see what happens. Stocks did open lower, but nothing huge. Like I said, a sleepy market just digesting some big annual gains. We got Fed head Goolsbee to say that he does see a downward path, still touting that line of an uncertain timeline, though. I continue to stay away from the too much politics, especially since I've told you over and over again that in the long term, it has very little influence. But as I also continue to say, sometimes the short-term reactions do present opportunities. By midday on Friday, healthcare was down over 5%. See RFK to HHS. Materials and information technology were also down about 3%. Financials and energy, they led on the upside. The first week as a Dow component, NVIDIA, who will report earnings this week, was down about 2%. Speaking of earnings, some stats to share here. And yes, I am frustrated by some of these stats. First, looks like earnings growth for Q3 was about 5.5%. Not bad. 75% of the S&P 500 companies beat estimates. This one frustrates me because the report was that was disappointing because the average is 77%. Really? 75 versus 77? Okay, looking ahead is somewhat of a concern. Only 80 companies in the S&P 500 forecast Q4 earnings, and 68% of them issued negative guidance, 32% positive guidance. 68% is higher than the 5-year average of 58% and the 10-year average of 62%. Make of that what you wish. Again, losing momentum, but not falling off a cliff. For the day, in the red, the Dow was down about 0.75%. Excuse me, the S&P was down about 1.33%, and the NASDAQ was down 2.25%. For the week, the markets gave back about 50% of those post-election gains. The Dow was down 1.25%, S&P was down a bit over 2%, and the NASDAQ was down almost 3.25%. Last week highlighted the market sensitivity to inflation data and Federal Reserve communications, as well as political news. This shows the importance of monitoring the eco data, policy signals, and other news from Washington in the coming weeks. Let's look into this week and let's see what things look like. I do get nervous for surprises when things look quiet, so take this with a grain of salt. Things do look quiet. There is some eco data, but mostly housing and some other secondary news. We will get labor numbers Thursday, University of Michigan inflation and sentiment data on Friday. Not to be missed will be the Fed heads, only a few, Goolsbee, Schmidt, and Hammock. Earnings will keep us hopping, though. Not to worry. As I mentioned, NVIDIA is due out Wednesday, and that will be built as the be all or end all. I don't think it will be earth shattering. We'll get more about, but we'll see what happens. We'll get more about the consumer, Walmart, Lowe's, TJX, and Target. Add in John Deere and Palo Alto Networks. Again, I think you'll see the most hot air on NVIDIA and Target and Walmart. And before we go, one more of those stats thing. According to MarketWatch, as of November 11th, the S&P 500 index was up 36% over the last 52 weeks. Since 1995, there have been 8 other instances in which the index experienced rallies of the same multitude. Following these prior instances of the gains of over 36%, the index tended to gain 1% over 1 month and rise another 4% over 6 months on average. Sounds like a good omen. No, we'll see what happens. Like last week, look at the numbers, though. Since 1995 is the key, the math. Since 1995, there have been 29 market years. The stat to tell you again, 8 times. 8 out of 29. Is that really worth a mention? Not a convincing percentage. It is when everyone is talking rainbows and unicorns, as I've said. If you're paying attention, you would think that in the past month, markets are flying. No? So let's just give you an idea of the last 30 days. The Dow was up 1/3 of 1%. The S&P was up 1/10 of 1%. The NASDAQ was up 1%. Please don't let the noise get to you. This is Psychology 101 or Marketing 101. Know what's really happening, not what the media you're consuming is making you feel like is happening. Not a bear here. I just want everyone to get a good idea of what they have and what their risk is. Please call me to talk about this. Risk audits are on the agenda. For now, maybe the market will take the rest of the month off this week, then Thanksgiving week. Too much to ask? Well, we'll just see. We'll see if they can just give us a quiet tone. We'll have to see. We'll start another week. We start another week to see what happens. Have a great week. Please contact me for a risk audit, and we'll talk soon.